While the mainstream media obsesses over a 2% dip in Bitcoin price, something unprecedented just happened in the shadow of the blockchain. In May 2026, a single entity, Binance, captured a staggering 78% of all centralized exchange net inflows. This isn't just a minor shift, it is a capital siphon of a magnitude we have never seen. While retail is panicking over the latest PPI inflation data, the smartest money in the room is quietly moving trillions in stablecoins into position. They aren't exiting the market, they are preparing for a strike. The question is, what do they know that you don't?
Let's look at the raw data from DefiLlama. While the headlines scream crypto winter, the stablecoin inflow chart looks like a vertical wall. USDC and USDT are flooding into Binance at a rate of $4.2 billion per day. This is the silent rally. It's a rally in purchasing power that hasn't hit the order books yet. Historically, whenever we see stablecoin dominance on exchanges spike while prices remain flat, we are in the eye of the storm before a massive liquidity injection. This is the dry powder that will ignite the next leg up.
Why is this happening now? The PPI inflation data just came in hotter than expected, causing a flash crash in traditional markets. Usually, crypto follows suit. But this time, the capital isn't leaving the ecosystem. It's simply rotating from volatile assets into stable parking spots. It's a hedge. Traders are fleeing the uncertainty of the US dollar's purchasing power, but they aren't going back to fiat. They are staying on-chain in Binance's vaults. This is a fundamental shift in how macro volatility affects the crypto-native capital cycle.
For months, the narrative has been that Wall Street ETFs are the only engine for growth. But look at the tape. BlackRock and Fidelity are seeing record outflows this week. If you only watch the ETF data, you'd think the bull market was over. But here's the disconnect. For every dollar leaving a spot ETF, nearly $2 are being deposited as stablecoins on centralized exchanges. The institutions are selling their paper Bitcoin, but the whales and crypto-native elites are accumulating raw liquidity. We are witnessing a massive transfer of power from the TradFi wrappers back to the native exchanges.
Who is behind this? On-chain forensics show a cluster of mega whale wallets, dormant since 2023, suddenly becoming active. These aren't retail traders buying the dip. These are market makers and sovereign wealth scale entities. They aren't buying Bitcoin at $80,000. They are parking stablecoins and waiting for the exact moment of peak liquidations. They are the ones who provide the floor when everyone else is forced to sell. By moving to Binance, they gain access to the deepest liquidity pools on the planet, preparing for a rotation that will catch 99% of the market off guard.
Binance has effectively become the world's central bank for crypto. By capturing 78% of the inflows, they have created a liquidity vacuum. When the rotation begins, it won't be a slow climb. It will be a vertical squeeze. Because so much capital is concentrated in one place, the speed of execution will be near instantaneous. If you are waiting for a signal on your local exchange, you will be too late. The price action starts where the money is, and right now, the money is all in one place.
Think about the irony. The media tells you institutions are scared of crypto because of regulatory hurdles. Yet, the on-chain data shows these same institutions are moving their cash into the very exchanges the regulators are targeting. They are voting with their capital. They prefer the utility and speed of Binance's stablecoin rails over the slow, bureaucratic mess of the traditional banking system. This is the ultimate vote of confidence. They are betting on the infrastructure, not just the asset.
History doesn't repeat, but it often rhymes. We saw this exact setup in late 2020 and again in early 2023. A massive buildup of stablecoins on exchanges, followed by a period of low volatility. In both cases, the result was an altcoin summer that saw the top 10 projects gain 500% or more in a matter of weeks. We are currently at a 3-year high for the stablecoin supply ratio on Binance. The spring is coiled tighter than it has ever been. When this dry powder is deployed, the cap on the market will simply vanish.
What happens when this capital rotates? It doesn't all go back into Bitcoin. The Binance Capital Siphon is specifically targeting high-utility Layer 1 networks and AI-integrated protocols. We are seeing early feeler trades into the top 10 alts. The ratio of stablecoins to altcoin market cap is at an all-time high. This means there is more potential energy per altcoin than at any point in crypto history. When the pivot happens, the move will be so violent that sidelines capital will be forced to chase the pump, creating a feedback loop of massive proportions.
So what is the trigger? Watch the CEC to DEX transfer volume. The moment we see these stablecoins moving from Binance's hot wallets into decentralized yield farms and L1 bridges, the fuse is lit. This is the moment the dry powder becomes active fire. We are already seeing the first $100 million test transactions. This is the quiet phase before the explosion. If you're waiting for the 20% green candle to buy, you've already lost the game to the whales who are positioned right now.
To trade this, you need to look past the price charts. Monitor the Binance net flow indicator on Glassnode and the large transaction volume on Into the Block. You are looking for a decrease in stablecoin balances paired with a spike in outflow of major altcoins. This signifies that the big players are moving their bought assets into cold storage or DeFi, reducing the sell-side liquid supply. When the supply on the exchange drops while the stablecoins are still present, you have a supply shock. That is your entry signal.
The 78% siphon is a warning. It's a warning that the market is being cornered by those with the deepest pockets. You can either follow the noise of the inflation data and the ETF headlines, or you can follow the money. The capital is parked. The whales are ready. The only thing missing is the spark. Are you going to be the one providing the liquidity at the top, or the one who followed the siphon to the bottom? The data is clear. The choice is yours. Stay sharp.